The Dow Jones plummeted nearly 1,000 points today. Investors are reeling. The sudden drop has sent shockwaves through the financial markets, leaving traders and analysts scrambling to make sense of the situation. The sheer magnitude of the decline has not been seen in recent years, and it has left many wondering what could have triggered such a dramatic fall. The culprit? President Trump's latest tariff announcement. In a move that has caught many by surprise, the president has decided to impose new tariffs, shaking the very foundation of international trade agreements. His announcement has been met with a mix of shock, confusion, and concern from both domestic and international stakeholders. This time, Canada is in the crosshairs. Our northern neighbor, known for its strong trade relationship with the United States, is now facing the brunt of these new tariffs. The implications for Canadian industries and the broader North American economy are profound. Trump slapped a 50% tariff on Canadian steel and aluminum. This hefty tariff is expected to have significant repercussions for manufacturers and consumers alike. The cost of raw materials will skyrocket, leading to increased prices for a wide range of products, from automobiles to household appliances. This is on top of existing tariffs on China and other trading partners. The global trade landscape is becoming increasingly complex and fraught with tension. Countries around the world are grappling with the ripple effects of these tariffs, which are disrupting supply chains and altering trade dynamics. The market hates uncertainty, and Trump's trade war is creating a whole lot of it. This is serious stuff. Investors are finding it difficult to predict market movements, and the resulting volatility is causing widespread anxiety. Financial analysts are warning that the prolonged uncertainty could lead to a more sustained economic downturn. We're talking about a full-blown trade war. The stakes are incredibly high, with potential consequences that could reshape the global economic order. Trade wars have historically led to reduced economic growth, higher prices for consumers, and strained international relations, the kind that can send the global economy into a tailspin. But hold on. While the situation is undoubtedly serious, it's important to keep things in perspective. The global economy is resilient, and there are mechanisms in place to mitigate the impact of such shocks. Before you panic, let's take a deep breath. It's crucial to stay informed and not make hasty decisions based on fear. Consulting with financial advisors and staying updated on the latest developments can help navigate these turbulent times. And remember, we've been here before. History has shown that markets have the ability to recover from even the most severe downturns. Past trade disputes have eventually led to new agreements and a return to stability. While the road ahead may be challenging, there is hope for a brighter economic future. Some sectors are feeling the pain more than others. The trade war has sent shockwaves through various industries, creating a ripple effect that is hard to ignore. Businesses are grappling with uncertainty, and the immediate impact is visible in the shuttered storefronts and empty shopping malls. The atmosphere is one of caution and concern as companies try to navigate these turbulent times. Tech stocks are getting hammered. The technology sector, which has been a powerhouse of growth and innovation, is now facing significant challenges. Stock prices are plummeting, and the mood in tech offices is somber. Employees are worried about the future, and investors are pulling back, leading to a sharp decline in tech stock valuations. The Nasdaq is down big. This index, which is heavily weighted with tech companies, has seen a substantial drop. Financial analysts are busy dissecting the reasons behind this downturn, and the consensus is clear. The trade war is a major contributing factor. The uncertainty surrounding tariffs and trade policies is causing investors to rethink their strategies. Why? Many tech companies rely on global supply chains. These intricate networks span multiple countries and are essential for the production of tech products. When tariffs are imposed, these supply chains are disrupted, leading to delays and increased costs. The impact is felt across the board, from small startups to tech giants. Tariffs disrupt those chains and eat into profits. The additional costs are often passed down the line, affecting not just the companies but also the consumers. Profit margins are shrinking, and businesses are finding it harder to stay competitive. The stress is palpable, as factory workers and executives alike worry about the future. Industrials are also taking a hit. Factories that once buzzed with activity are now eerily quiet. The industrial sector, which includes manufacturing and heavy machinery, is experiencing a slowdown. Stock prices in this sector are falling, and the number of active workers is decreasing. The ripple effect of the trade war is being felt far and wide. Companies like Boeing and Caterpillar rely heavily on exports. These giants of the industrial sector depend on international sales to drive their growth. However, with tariffs making their products more expensive overseas, their competitive edge is being eroded. The result is a decline in sales and a hit to their bottom line. Tariffs make their products more expensive overseas, hurting sales. The increased costs are making it harder for these companies to compete in the global market. International clients are looking elsewhere for more affordable options, leading to a drop in orders and a slowdown in production. The impact is being felt not just in the US, but around the world. But it's not all doom and gloom. Amidst the challenges, there are sectors that are finding opportunities. Some businesses are adapting and even thriving in this new environment. Financial analysts are identifying areas of growth, and there is a sense of cautious optimism in certain quarters. Some sectors are actually benefiting from the tariffs. Industries that were previously struggling are now seeing a resurgence. The tariffs have created a more level playing field for certain domestic producers, leading to increased demand for their products. This has resulted in rising stock prices and a more positive outlook for these sectors. Steel and aluminum producers, for example, are seeing their stocks rise. These industries have been given a boost by the tariffs, which have made foreign imports more expensive. As a result, domestic producers are experiencing increased demand and higher stock valuations. Workers in these factories are busier than ever, and the mood is one of optimism. The tariffs make their products more competitive against foreign imports. This has led to a resurgence in domestic production, with steel and aluminum companies ramping up their operations. The increased competitiveness is a welcome change for these industries, which have struggled in recent years. The celebration among steelworkers is a testament to the positive impact of the tariffs on their livelihoods. This is a classic case of short-term pain for potential long-term gain. While the immediate impact of the trade war is challenging, there is hope that the long-term benefits will outweigh the short-term difficulties. Investors are looking at the bigger picture, and there is a belief that the current struggles will lead to a more robust and competitive economy in the future. Remember 2018? It was a year of significant upheaval in the financial markets. The headlines were dominated by trade wars, political uncertainty, and economic forecasts that seemed to change by the hour. Trump imposed tariffs on Chinese goods. The market freaked out, investors were on edge, and the trading floors were filled with anxiety. The fear of an escalating trade war sent shockwaves through the global economy. But guess what? The market recovered, and then some. Despite the initial panic, stocks bounced back stronger than ever. The resilience of the market was on full display as it climbed to new heights. Why? Because the American economy is resilient. It has a remarkable ability to absorb shocks and continue growing. The strength of the economy lies in its diversity and adaptability, and because businesses and consumers adapt, they innovate, find new ways to operate and continue to drive economic growth. This adaptability is a key factor in the economy's resilience. They find ways to work around tariffs. They find new suppliers. Businesses are constantly looking for ways to mitigate risks and find opportunities. Even in challenging times, they adjust their spending habits. Consumers become more cautious, looking for value and making more informed purchasing decisions. This shift in behavior helps stabilize the economy. The same thing will happen this time. History has shown us that markets have a way of bouncing back. The current challenges are no different, and we can expect a recovery. Will there be bumps along the way? Of course. Market volatility is a given, and there will always be periods of uncertainty. But these are often followed by periods of growth and stability. But the market has a knack for climbing that wall of worry. Investors learn to navigate the uncertainties, and the market continues its upward trajectory over the long term. And remember, the market is forward-looking. It anticipates future events and adjusts accordingly. This forward-looking nature helps it to recover from setbacks and continue growing. It's already pricing in the potential negative impacts of the tariffs. Investors are factoring in the risks and making informed decisions based on their expectations of the future. Any good news on the trade front could send stocks soaring. Positive developments in trade negotiations can boost investor confidence and drive market gains. So keep an eye on the headlines and stay informed. Trump's tariffs are a gamble, a high-stakes gamble. But there's a method to his madness. He wants to bring manufacturing jobs back to America. He wants to reduce our dependence on China. Is it a long shot? Maybe, but it's not impossible. Think about it. Tariffs make imported goods more expensive. This makes American-made goods more competitive. Companies have an incentive to bring production back to the US. This could lead to a resurgence in manufacturing, more jobs, higher wages, a stronger economy. Section 5. Breaking the chains, reducing dependence on foreign imports. For too long, we've relied on China for cheap goods. We've become hooked on their low prices. But this dependence comes at a cost. We've lost millions of manufacturing jobs. We've outsourced our industrial base. And we've become vulnerable to supply chain disruptions. Trump's tariffs are a wake-up call. It's time to break our addiction to Chinese imports. It's time to rebuild our own manufacturing capabilities. It's time to bring jobs back home. It won't be easy, but it's necessary for our long-term economic security. Section 6. The Fed's move rate cuts on the horizon. The Federal Reserve is watching the trade war closely. They know that tariffs could slow economic growth. They know that businesses and consumers are feeling uncertain, and they're prepared to act. How? By cutting interest rates. Lower interest rates would be a boon for the stock market. Why? Because they make it cheaper for companies to borrow money. This can lead to higher profits and more investment. Lower rates also make stocks more attractive to investors. So keep an eye on the Fed. Their next move could send a strong signal to the markets. Section 7. A time for bargains, investing in the age of tariffs. The market turmoil has created some incredible buying opportunities. Many stocks are on sale, but you have to be selective. Look for companies with strong balance sheets. Companies that are less exposed to trade tensions. Companies that pay dividends. These are the companies that will weather the storm. Consider investing in sectors that benefit from tariffs. Steel, aluminum, manufacturing. These sectors are poised for growth. Also, look for companies that are bringing production back to the US. These companies are making a long-term bet on America. Section 8. The long game, patience, and the promise of growth. Investing is a marathon, not a sprint. Don't panic over short-term market fluctuations. Stay focused on your long-term goals. Trump's tariffs are a gamble, but they could pay off big time for America. If they succeed in revitalizing our manufacturing sector, we could see years of strong economic growth. Remember, the American economy is a powerful engine. It's weathered many storms before, and it will weather this one too. Stay patient, stay invested, and remember, fortune favors the bold. Section 9. Join the debate, your voice matters. What do you think about Trump's tariffs? Are they a recipe for disaster or a stroke of genius? Share your thoughts on social media using the hashtag #TariffTalk. Let's get a conversation going, because your opinion matters. This is a pivotal moment in our nation's history. The decisions we make today will have a lasting impact on our economy and our future. Please click on the subscription button and leave a comment below.